Here's a question that should bother you. After 130 years of financial technology, ATMs, electronic trading, the entire internet, the cost of financial intermediation hasn't budged. It's still roughly 2%. That's the Philippon puzzle, and it's the starting point for understanding fintech theory. To crack this, you need three analytical lenses working together. First, intermediation theory. Banks, insurers, exchanges, they all exist to solve five fundamental frictions that prevent capital from flowing efficiently. Information asymmetry, transaction costs, liquidity creation, risk sharing, and trust. Fintech doesn't eliminate these frictions, it reprices them. Upstart uses alternative data to attack information asymmetry. Stripe's AP is compressed transaction costs. Blockchain substitutes cryptographic proof for institutional trust. Second lens, innovation theory. Clayton Christensen's disruption model maps perfectly onto fintech. Incumbents like JP Morgan spend billions optimizing for their best customers. Meanwhile, M-Pesa enters with simple SMS payments for people banks completely ignored. Robinhood offers zero commission trades to retail investors, the industry considered unprofitable. The disruptor starts at the bottom and moves up, and by the time incumbents react, the cost structure gap is too wide to close. It's a structural advantage, not just a speed advantage. Gary Pisano adds a crucial dimension. His landscape map separates technical novelty from business model novelty. This helps us categorize the type of threat an incumbent faces. DeFi protocols like Uniswap change both the technology and the business model. That's architectural innovation, the hardest for legacy institutions to respond to. Third lens, business models. The big divide is one-sided versus multi-sided platforms. This is where the real value capture happens in the modern digital economy. Robinhood is the textbook case. Zero commission for retail traders on one side, payment for order flow from market makers on the other. The product is free, but the revenue is higher than ever. In fact, by leveraging this multi-sided model, Robinhood earns more per user through order flow than E-Trade ever did through traditional commissions. It's a complete shift in economics. And watch the agency to principal migration. Fintechs that started capital light, earning fees and commissions, are increasingly becoming full-scale banks. SoFi is the prime example. They got a bank charter and went from simple transaction fees to net interest margins of nearly 6%. They are playing the long game now. The economics of holding a balance sheet, especially in a higher rate environment, are just too attractive to ignore. It's the natural evolution for successful fintech players. So how do you know which incumbents are vulnerable? McKinsey identifies four signs: cross-subsidizing customers, forced bundling, access friction, and lagging user experience. When all four are present, when customers are forced to pay for things they don't want through clunky interfaces, that's where the next Revolut shows up to take market share. We are moving beyond simple apps and into a world where the fundamental theories of finance are being rewritten in code. The puzzle isn't solved yet, but the pieces are moving. This has been Chapter 2, Theories and Business Models. In the next session, we'll dive deep into the plumbing of decentralized finance. I'll see you there.